In credit markets, you can find opportunities that go from 5% on the safe side of the spectrum to 10% on the more risky side. And on both sides, basically, you will have that valuations are relatively attractive compared to historical average and compared to the macro outlook. At global level, inflation is on its way down. In the US, inflation is now running around 5%, basically half of its peak of around 9% in the summer last year. In Europe, we are tracking 6% versus highs reached at 11% in October. And in both continents, core inflation is running at 5%. When you look at the global drivers of inflation, commodity prices, supply bottlenecks, and most recently core services and goods and real estate markets all points out. So all leading indicators basically say that inflation has more room to go down. This decrease in inflation is also happening at a time where the economy is slowing. As a result, central banks are very, very close to the end of their hiking cycle. The ECB will probably stop between 3.75% and 4%, and the Fed will stop around 5.5%. Interest rate markets are already pricing these terminal rates both in Europe and in the US. So the hiking cycle is near to its end, but that doesn't mean we are going to have cuts. Core inflation will remain relatively high for the remaining part of this year, and will land between 3.5% and 4% both in the US and Europe at the end of this year. So with core inflation pressure going down, but the level of core inflation remain relatively high, central banks will be able to stop hiking over the next couple of months, but they will not be able to cut interest rates over the next 6 months. Stable interest rates is a very good news for rates and credit anyways. Usually when rates become stable, markets can price cuts over a 2-year horizon, and credit spreads remain relatively high compared to the past couple of years. So in credit markets, you can find opportunities that go from 5% on the safe side of the spectrum to 10% on the more risky side. And on both sides, basically, you will have that valuations are relatively attractive compared to historical average and compared to the macro outlook. Last but not least, the economy is slowing, but is not tanking. When you look at PMIs, they are now hovering around 50, which would imply 0% growth both in the US and Europe, but they don't imply a very strong recession, as some feared when we had this wave of financial stress in March and April. Emerging market assets are also set for a good 2023 after 2022 was difficult given the move in core rates. In particular, local markets are extremely attractive. So emerging market debt denominated in local currency is probably one of the most interesting areas in the market. In 2021, most of emerging market economies started tightening interest rates very, very aggressively because inflation started going up earlier than in developed markets. The tightening cycle was deep. Just to give you an example, Brazil started 2021 with interest rates at 2% and ended in mid-2022 with interest rates at 14%. As a result, inflation collapsed. It made its highs around 14% in 2022 and is now running below 4%. So emerging market economies are 1 year earlier than developed market economies in the tightening cycle, and as a result, they will be able to cut interest rates 1 year earlier than developed markets. I could talk about Mexico, Colombia, Peru. There are many places in which this dynamic, which I described for Brazil, is actually true. For this reason, we think emerging markets are a very strong opportunities, especially in local markets, and importantly, 2022 was a year in which the dollar appreciated strongly, so even the currency bit of the trade can work very nicely. In terms of growth, we think emerging market will outperform developed markets in 2023. China is opening up. It's not opening up as strongly as expected by the market a few months ago. A couple of months ago, consensus was for growth between 6 and 7% in China for this year. Most likely will be between 4 and 5%, but this is happening in a situation in which growth in the US and Europe will be zero or moderately negative. As a result, the growth gap between emerging markets and developed markets will be at 10-year highs this year, in a situation in which US interest rates start from a high level and the US dollar start from an expensive level from a multi-year perspective. Europe is set to outperform the US across several asset classes. First of all, many of the banking fears we had in March and April are just more concrete in the US. In the US, we know that regional banks have some mismatch on their balance sheet, and this is affecting credit creation. In Europe, of course, there was some reverberation of the stress coming from the US, but European banks have been stress tested for the past 15 years, and as a result, the system is healthier and their balance sheet is stronger. So the big increase in bank spreads, especially in subordinated debt, is just more attractive in Europe, where fundamentals are more solid. Second, the dollar is very strong, and this was the result of 2022, where we had a massive rally in the greenback, and Europe is just more exposed to China and Asia, which is growing faster than the US. So generally speaking, asset valuation are just cheaper in Europe, and the exposure to Asia, which is going to be the main force behind the global growth in 2023, is stronger.